Despite starting off to a rocky beginning, 2023 was surprisingly a great year for the market. But is this just a dead cat bounce with chaos and catastrophe just lurking around the new year? If we want to figure out where we are going to go in 2024, we'll first need to see where we are in terms of the market cycle. In this video, I'll show you 3 interesting indicators for determining how hot or how cold the market is, as well as how we here at Flank think about market cycles. Make sure you stick around to the end, where I'll share a company that I'm currently deep diving in and might be taking a position in shortly. The S&P 500 gained over 20% in 2023. This is a very good year for the market. For context, the historic return of the S&P 500 is just 10.7% over the past 50 years. This logically follows that the market is thus overheated and will need to cool off in 2024. But literally no one knows if it will or not. However, there are certain indicators that can help us get a general sense of where we are. We do like some more than others. Our first one, and it's our best one if you want to sound smart at your next dinner party, is to look at the Schiller P ratio. You may have heard of P ratios before, but if you haven't, as a reminder, they stand for price to earnings ratio and represent how expensive a stock is. Now, P ratios are not the only determinant of a value stock. However, dogmatic value investors will say that a PE ratio over 20 is considered expensive and a PE ratio less than 20 is considered a value buy. There are certainly exceptions though. Okay, now that we have a refresher on the fundamentals, back to our man, Dr. Robert Schiller. Investors have long calculated the cumulative S&P 500 general PE ratio. So they take all 500 companies in the S&P 500 and take their cumulative price and divide it by their cumulative earnings per share, which for fun is currently at 25.86. PE ratios are normally reported as trailing 12 months PE ratios. And look at how volatile this is. But what Dr. Robert Schiller did that makes it a little more interesting, decided to normalize corporate earnings over a 10-year period as opposed to the 1-year period to better reduce short-term noise and gauge where the market is in terms of a super cycle. The current Schiller ratio is sitting around 32, which means we're pretty high, like right before the Great Depression high, or approaching dot-com level high. This indicator hasn't held up in recent times and is seen as more academic than pragmatic, but this is just one of the indicators in our toolkit. A more short-term indicator is CNN's Greed Fear Index. This is an interesting graph that takes into account 6 different metrics: market momentum, stock price strength based on 52 weeks highs and lows, stock price breadth, which looks at the volume of shares trading on the New York Stock Exchange that are rising compared to the number that are falling, puts and call options over a 5-day average, market volatility as determined by the 50-day moving average of VIX or the Fear Index, and finally safe haven demand, which represents if the market is buying or selling more stocks than bonds. Now, if this sounds like a bunch of indicators that you've never heard of before, then good. A lot of this is derived from technical analysis, and it is our strong belief here at Flank that investors should focus on fundamental investing as opposed to technical analysis. This is because we have to play to our strengths. I'm going to go ahead and assume that you do not have a team of quants, economists, and data scientists like hedge funds do, so you cannot compete with these guys. And these guys love to play in the technical analysis arena, which is why we can beat hedge funds if we passively index or invest in a long-term metric. But at the end of the day, it's still a fun indicator, and I do find myself checking it from time to time. Per this indicator, we've just entered extreme greed territory, which means investors should be wary because we want to be fearful when others are greedy and greedy when others are fearful, if you believe in technical indicators. Okay, that was far too much talk of technical analysis. I need to go rinse my mouth out. When I get back, we'll talk about the Buffett Indicator. Okay, Warren Buffett called this next one the single best measure of where valuations stand. The Buffett Indicator, a term he's never used himself, is the total value of all US stocks over GDP, or GNP. It takes that percentage to see where we stand in terms of valuation. It's beautifully simple, classic Buffett, making things as simple as possible, just not any simpler. Buffett stated himself, quote, "If the percentage relationship falls to the 70 or 80% range, buying stocks is likely to work very well for you. If the ratio approaches 200%, then you are playing with fire." As this chart shows, right before the dot-com bust, the Buffett Indicator was at 190%. The current Buffett Indicator is at about 168%. However, for any of you data nerds out there, we pulled this reference from a Fortune magazine article, which is still listed on Berkshire's website. If you've never been to Berkshire's website, you gotta go. It looks like it was written in 1985. It's fantastic. This chart isn't aligning with the chart that was referenced in that 2002 article. The two possible errors I see, as a data nerd myself, either he didn't use the Wilshire 5000, which is a measure of 5,000 US stocks, or this chart uses GDP instead of GNP. I'll give you a call out in the next video if you square this for us. Now, it's important to say that he also has this belief on the market.
As to the criteria as to when you should or shouldn't, I don't think there are any great criteria on that. I don't think price-earnings ratio, determines things. I don't think price-book ratios, price-sales ratios. I don't think there's no single metric I can give you, or that anyone else can give you, in my view, that will tell you this is a great time to buy stocks or not to buy stocks or anything of the sort. It just isn't that easy. That's why you go to an index fund, and that's why you buy over a period of time. It isn't that easy. You can't get it by reading a magazine. You can't get it by watching television. You'd love to have something that said, if PEs are 12 or below or some number you buy, and if they're 25 or above you sell. It doesn't work that way. It's a more complex business than that. It couldn't be that easy when you think about it.
This is what we've been saying. If you are interested in single stock picking, which you presumably are since you're here, then there is no magic indicator. It's only slightly better than just mental masturbation to check overall indicators. And let me be clear, I do check these indicators, but we have to keep ourselves honest. Overall market dynamics will trump individual company performance in the short run, but if we focus on buying fantastic companies at great prices, then we can find opportunity in almost any market. This is easier said than done, especially when we're in greed territory. So how do we go about finding fantastic companies at great prices? We can find them by following the news and by paying attention to our surroundings. But this does lack a system and methodology. I'll propose that we can find opportunities through discussion and analysis inside of a community of other like-minded investors, so long as that actual community sits on top of the fundamental data that's being analyzed. Of course, this is exactly what we're trying to build at Flank. Come check us out. We're just getting started with our closed alpha. There will be a link in the description below to both the sign up page for our alpha and to join our Discord, which we'll use to help us communicate better in the short run. We want you to sit on the factory floor with us as we build this thing, and we want to build it for you. Now, as I said at the top of the video, in 2023, the S&P 500 gained over 20%. However, if you take out just 7 stocks, the Magnificent 7, which includes Apple, Amazon, Alphabet, Meta, Microsoft, Nvidia, and Tesla, which combined gained a staggering 71% this year, then the remaining 493 companies in the S&P 500 only returned about 6%, which only slightly outpaced inflation. So, these 493 companies might be the place to look if you think we're in a bit of an AI hype cycle. In fact, you can see here that many sectors outside of tech have had a mixed year. Consumer discretionary has been beaten up really bad this year. Barron's released their 2024 predictions, and most of their experts seem to agree. But I did promise you at the top that I'd give you a company that I'm zeroing in on, and it's the McDonald's company. I think McDonald's could be a bit of a sleeping dragon, and the more I'm looking at it, the more I like. But before I talk more about their moat, let me talk about their business model. It's pretty common knowledge that McDonald's is more of a real estate company than a hamburger company. And if you look into their financial statements, that's true. But it all comes from their franchise model, which they have crafted in a very unique way. Over 90% of their restaurants are franchised, and they've set that guidance to increase it to 95%. So where does the idea arise that they're a real estate company? When you sign up to be a McDonald's franchisee, you will most likely fall into their most common conventional franchise model.
The franchisee, that is the local owner, generally makes a total upfront investment of $1 to $2 million for a single location, including an initial down payment paid in cash, one-time franchise fee of $45,000, and a % royalty of every month's revenues. These usually 20-year contracts also have the unusual but highly consequential stipulation that the restaurant be located at that specific address, the one McDonald's, the corporation, just bought. In other words, McDonald's instantly has a tenant, and one who will always pay above market rates.
Under this agreement, McDonald's owns the land and the buildings, and the franchisee pays McDonald's for the equipment, signs, seating, and decor. This is where the idea that most of their revenue comes from the tenant paying rent. So much so that rent accounts for 64% of their franchise fees. 35% comes from royalties and 1% comes from that initial startup fee. The royalties are a percentage of each month's revenue. And I like this model. Real estate is a much better business than hamburgers. The first reason is because of our tax law. Our tax law allows for significant tax advantages to be associated for depreciation. Now we understand a little bit more of how McDonald's actually makes money. How are they going to make more money in the future? How are they going to continue to compound? The first thing I want to comment on is their planned growth. By the end of 2027, they want to expand the number of McDonald's restaurants from 40,000 to 50,000, a 25% growth in just a little bit over 3 years now. Most of these will be overseas, which McDonald's has been extremely effective at expanding into. Many consumer companies talk a big game about expanding overseas, but few can deliver. One thing I do as I research a company is that I put on just random videos about that company in the background. I just wanted to show this one by Dan Lok. I don't know who he is, but he has 4.72 million followers on YouTube. Here's what he said about the McDonald's business model.
They own a piece of real estate, they make money monthly. But that's not the biggest business. The third business is not even the royalty. They get the royalty income too, multiple streams of income right there. But the biggest business they have, McDonald's right now is the largest suppliers to this. Your straw, your napkin, the burger meat, that's where the business is.
This is just plain wrong. McDonald's does not make money from supplying wholesale to franchisees. They don't even talk about it in their annual report. And they list their suppliers right on their website. I don't want to disparage Mr. Lok. He's obviously doing just fine with his businesses. But I do highlight this because it's an extremely important point. There's bad information out there. And with his massive online presence, there's no reason to believe that this isn't how McDonald's actually works. He should be able to research these things. Anyway, one thing I really like about McDonald's is that they were the only company other than Walmart to gain value during the 2008 financial crisis. This does offer downside protection in case the soft landing predicted by most economists doesn't pan out. McDonald's is currently a dividend aristocrat as it has increased every year for 25 years, but they've been increasing their dividend for 47 years. So at year 50, they will be known as a dividend king. A very honored title in the market. Think about how amazing that is. Through all the downturns over the past 50 years, they've managed to keep increasing the dividend. This is a resilient business model. If we're not sure about valuations, this is a good place to park our cash. During the course of my deep dive, I found one thing that is giving me pause. If you look at McDonald's or look at a Google review for their new Cosmic restaurant, you can see that there's a very big protest going on over the war in the Middle East. They're going to be reporting Q4 results soon, and I want to see how it has impacted their revenue. You can tell by their marketing that they are attempting to attract Gen Z into the restaurant. One thing I've learned over the years is that Gen Z does vote with their dollars, which I love. I see no reason to jump into this investment at the moment, so I'm going to hold off on taking a position for now. But I may reevaluate that when I take a look at the 23 annual report. I read annual reports all the time, and I really do wait to see when one really hits. Buffett uses the analogy of a baseball batter, except we don't have 3 strikes. We have unlimited strikes until one enters our hit zone, and then we can swing. That's been my most successful stock picks, and I will be patient enough to do it. Anyway, when the 23 annual report comes out, I'll be making my own annotations to it, and I'll publish that PDF to our Discord channel. So if you want to come check it out, the link to the Discord will be in the description. I really hope you come join us. Thank you so much for watching. I hope you got some value from this video. Please let me know in the comments below if there's anything else you'd like to talk about, or if there are any other companies that you would like to see me research in the future. We'll see you next time.